by award-winning author and journalist Sebastian Mallaby. Mallaby is the author of several books focused on the financial world, including More Money Than God, a superb history of hedge funds, The Man Who Knew, The Life and Times of Alan Greenspan, which won the 2016 Financial Times and McKinsey Best Book of the Year award, and most recently, The Power Law, Venture Capital and the Making of the New Future, which is a finalist for the same award. Mallaby has an extraordinary ability to transform the stories of the people behind the economic headlines into page-turners. We'll talk to him about how he developed this approach and why he's drawn to particular figures. We'll also discuss why he believes venture capital firms and hedge funds are important to the financial ecosystem. This is a unique opportunity for our New Zealand listeners to hear directly from one of the world's most insightful and entertaining financial commentators. Welcome, Sebastian. It's great to have you here.
Well, I'll try to follow up on that intro. It's going to be tough.
I guess that's a modest way of saying you're one of the some of your books are some of the most profound pieces of literature in the finance world, and perhaps I'm biased because I'm an investor by career, but also by passion. But should we perhaps start with a bit of a congratulations on being longlisted for the FT Business Book of the Year award for The Power Law? And the book is incredibly compelling, entertaining as well. So it's not a textbook. It's an entertaining journey through the history of venture capital, how it shaped Silicon Valley, which is an entire subject in itself, and perhaps how technology in Silicon Valley has really shaped and transformed society. But I want to start with the title of the book. This is the part that I'm really excited about. The Power Law. What is power law?
In some ways, the best way to explain the power law is to explain at the beginning what it isn't. So lots of phenomena in life have this familiar bell curve, so-called normal distribution, where if you take a bunch of, let's say, American men, and you measure them all, you're going to see that the average height is 5 feet 10 inches, and that nearly all the observations cluster around that. So between 5'7" and 6'1", that's accounting for like the vast majority of American men. And the outliers are actually not that huge statistically. So even a basketball star who's like 7 foot tall is 20% taller than the average or something. He's not, twice as tall. And so if you think about a movie theater, and the basketball player has shown up, he's one of 100 people there, and he gets bored of the movie halfway through and walks out. The residual man in the cinema has not seen the average height has not gone down much just because one basketball player walked out. Now, if we think about a power law distribution, it's radically different. It's not clustered around the average. Instead, you've got a small number of observations where something's happened and they've just gone not 20% bigger, but 10 times bigger, or even more than that. It's like the observation that one of the early statisticians in this field, Pareto, had, that 20% of the peas in his garden, of the pea plants in his garden, accounted for like 80% of the peas, or that 20% of cities account for 80% of where people live, or 20% of the earthquakes create 80% of the destruction. And in investing, it's very much like that, especially I'm talking here about technology startups, where you get some that are way out of the norm. And so just to go back to complete this, with the cinema, if you think about not the average height of American men, but the average wealth, and you imagine instead of the NBA star at the back of the cinema who's 7 foot tall, you've got Jeff Bezos, whose wealth is, thousands of times bigger than the average. If Jeff Bezos gets bored of the movie and walks out, the average wealth in the cinema plummets. It doesn't just, tick down a tiny bit. And so wealth is a power law distribution, just like when a startup investor at a venture capital partnership makes 10 bets, the outlier, the best one, is probably going to generate more returns than the other 9 put together.
And I guess that's the art of VC, isn't it? Where you mentioned this a number of times in the book, where some of the more successful funds invest in not one or two, in hundreds of different opportunities, and really it is one or two that makes more the returns. Is this something that is seen therefore as a success in an industry where there's a lot of failure, or do you think that's as part of VC and part of investing in the startup market?
I think it's baked into investing in the startup market, partly because all startups, even if you're talking about very simple ones like restaurants or something, have the power law pattern where the majority they'll fail in the first year or two, or they won't be that profitable or whatever, and then there'll be a few in the startup world that kind of survive and build and become real businesses. That's true of startups generally. It's true also of technologies. Lots of ideas for inventions end up either not working, the product doesn't work, or it turns out to be a product that other people don't want, or it turns out to be a product that people do want, but some big company like Google swoops in and builds it too fast, and the startup loses out. So in technology, even more than in normal startups, there are going to be some outlier winners, but most things will fail. And so I think if you're a venture investor backing startups, you've got to lean into that. And instead of worrying about how many bets you're going to make that go to zero, because that is the nature of the industry, if you don't accept that, you shouldn't do it. Don't worry about losing 1x your capital. Think about winning more than 10x on the outlier bet. And it's all about finding the outlier. And I think it's so counterintuitive to how we are wired to think as human beings, right? We know from behavioral economics that we have loss aversion. We don't like to lose. And so that 1x that you lose feels disproportionately painful. So you kind of have to train your mind to think in a power law way to be a good venture capitalist. And my theory is that that's why it was confined for so long to Silicon Valley, that there was one geography in the world where they really understood this and they were kind of trained into it. And therefore they dominated innovation between, let's say, 1980 and, 2010 or so. And then since 2010, the secret sauce has been bottled and exported. And I don't know if this fits with your observations in New Zealand, but geographically, China began to take off in the 2000s and went really big after 2010. India, similar story. Southeast Asia, similar story. Europe is starting to take off now. Israel was a bit earlier, but same kind of path. It just took time for people to start thinking in this power law way, and therefore to be able to do good technology investment.
Do you see the power law in other parts of finance, or is it, is it something truly unique to VC?
It is pretty unique to VC. I mean, if you look at the way that stocks behave in the stock market, it's much more of a normal distribution. Now, famously, it's not a perfect normal distribution, and that's why there are these tail events where you have a crash, right? Where, as it were, if you think about the bell curve, the left-hand tail is fat, meaning that there are more observations than a perfect bell curve would predict. And these crashes in the left-hand tail where, the middle of the distribution is a normal day in the stock market where it goes up by 1% or goes down by 1%. And the left-hand distribution is where it suddenly falls 23%, like it did in October 1987 in Wall Street on Black Monday. And those left-hand tails, we know from financial crashes, are somewhat more common. So it's not a perfect normal distribution, but it's pretty close. And it's very, very unusual for a hedge fund investor to bet on a stock and say at the end of 3 years, gee, it went up not 100%, but 1,000%. But in venture capital, a 10x return 1,000% is what it's all about. That's what you're looking for.
And at the same time, it's not often a hedge fund manager says, "Oh, and these 8 also went all to zero," which is
no, exactly. That would be career ending. Whereas, I went to Boston during my research, kind of quite early on, and I talked to the old timers who had been involved in so-called venture capital partnerships in Boston in the 70s, and I was curious because I was trying to understand why did Boston do less well than Silicon Valley, because historically, Boston had MIT, Boston had Harvard, Boston had great science. It should have been the leader in American tech. But it turns out that, I went to see venture investors in that area, and they would say things like, well, I made 40 investments in my career and I'm very proud because none of them lost money. If you say that in Silicon Valley, they think you're an idiot. They think you're not taking enough risk, that you don't get it, you don't understand the power law. So it was a fundamentally different mentality, much more risk-friendly in Silicon Valley, and I think that's why Silicon Valley did so much better.
Is the power law one level higher, where you choose your venture capital firms?
That's a great question. I think, yes, the answer is there is a power law when you choose the firms. I mean, the outlier firms dominate the total returns generated by the sector, partly because they have skill and partly because reputation is valuable in VC investing. If you've got a reputation as somebody who backs winners, then the best entrepreneurs will be lining up outside your door to be funded by you. And so you have superior deal flow that leads to knowing more about what's going on, being able to pick what you want to invest and what you don't want to invest in, maybe paying a little bit less to get into the deal because your reputation is valuable to the entrepreneur, so they'll take a lower valuation to have the privilege of your name on their cap table. So absolutely, I think that's a good point. There is a power law when it comes to the CIO selecting which VC partnerships to get into.
I mean, it was always the same old, that's probably the wrong word, young cronies that when you see, go through Crunchbase and see all the initial deals on all these successful tech companies, it was the same thing over and over again. And I think that's absolutely the case. When you think about Silicon Valley and the culture within Silicon Valley to create this environment of investing, I think the interesting thing about your book is you're not actually talking about the founder necessarily. There's heaps of podcasts where how they built that is the famous one where you talk to the founder about their idea and how they developed it, and they did it because they wanted to put their kid through college and now they're a trillionaire, or all those fantastic stories. You never really hear about the ones that didn't work. But you're talking about the venture capitalists that are identifying these founders, and I think the fascinating part of it is that juxtaposition between the Peter Thiels who are investing in people who are perhaps a little bit different from the norm, and want them to sort of embrace that, versus the other type of VCs who are looking for the founders like a Google and perhaps helping their idea go more down the straight and narrow path. Is there any way that's more successful? And when you talk to all these firms, is it the VC that makes them successful? Is the VC providing the capital and have identified the success anyway, and that they're going to be successful whoever the VC is?
There's a debate about that. I mean, there's both a debate in the academic literature over whether venture capitalists, A, create success because they back companies and then they actively help them. And also just in selecting the right companies to back, they are ensuring that resources get allocated to the successful ideas, the ones that are going to work. And that's a point about capital allocation, but also just manpower, human allocation, right? If the VC does a good job of screening out the ideas that are never going to go anywhere, it avoids having software engineers working for those ideas that are never going to go anywhere. And so the ecosystem will be more productive. Okay, so that's one view. But then view B is that the venture capitalists don't create success, they just show up for it. They just piggyback, they provide the money, they sit back, they get rich. They didn't really do anything. And one, that's a question posed in the academic literature. It's a serious question. It's also one which is obviously popular with large numbers of entrepreneurs who feel that they did all the work and the VC did nothing, particularly if that relationship went wrong at some point along the road. And I have the view that VCs very much do contribute to the value creation, because of what I said before, that allocating money to the promising ideas means that scarce resources, especially software engineers, go work at the right place. And also, after the investment, there are tons of case studies in my book of, companies that did have a great idea and maybe a great product, but didn't know how to sell it, didn't know how to manage the team without it falling apart because of internecine battles. And the VCs steered these operations away from the cliffs and turned what might have just been a failure into a success. I mean, Cisco, the great router, multi-protocol router company back in the day, which connected up all the computers to the internet and kind of made the internet possible, was a great piece of engineering to invent this device, the multi-protocol router. But the two founders were just not up to building a team that would have sold it and would have grown the company. And it was Don Valentine of Sequoia who invested, who hired all of the vice presidents, all of the key people in the company, who himself was the CEO for a bit, or at least the chairman. He put his partner from his venture capital firm in as the vice president for manufacturing. I mean, he was extremely hands-on in turning that thing into a sort of chaotic culture where literally there were fistfights amongst the staff, into something that really built a world-class company. And there are lots of those examples. So I think that VC does create value. It doesn't just show up for it.
Well, where's the boundary for VC? I mean, in that example, you're firmly in management land. So a good manager could have got the same outcome rather than a VC per se.
Yeah.
Do you have indicators that say, well, this is no longer a VC company, or perhaps it's the business is no longer early stage anymore, it's too big, so we can't class it as VC anymore? How do you sort of put them in the box to decide whether that we can actually analyze them?
Well, let me just refine the point I made earlier. The VCs in the example I gave of Cisco, themselves rolled up their sleeves and did management. But the more common pattern, but is still extremely valuable, is that the VC would connect a technical founder of a company with the management talent, the marketing talent, and so forth. And so they have the Rolodex. They have the ability to say, okay, you're going to need a go-to-market person, and you should have so-and-so. You need somebody who understands enterprise sales. You're going to sell your product to the big corporations, so you need somebody who already has contacts inside the big corporations and knows how to talk to those people. And I can offer you 5 candidates, and you can choose the one you like. So that kind of almost human resources recruitment sort of advice is extremely valuable, and VCs provide that. You can think of them as the super connectors, connecting the entrepreneur to both the customers that might become the first customers and the talent that might become, the early hires. So that's part of the answer. And you were asking a sort of separate question about when does it cease to be VC? And that's a great topic to get into, because it used to be that, in the 90s, you had a startup like Amazon, and it got backing from VCs, in this case, Kleiner Perkins. And then after 2 years or something, it goes public on the stock market and ceases to be a venture capital company. It becomes a public company. Of course, in the last 10, 15 years, we've had a shift towards this growth capital phenomenon where companies don't go private at that early point. Instead, they stay private because they raise money not from the stock market but from this new category of kind of big check venture capitalists. They're not writing checks for 25 million, 50 million. They're writing checks for $500 million. And that allows these companies to grow. Stripe, the payments company right now, is a great example, where before the bubble burst earlier this year, it was valued at almost 100 billion, as I recall, and yet it was still a VC company because it hadn't gone public on the stock market. So the boundaries have changed in the last decade. But I think a valuable distinction is between the early stage VCs, who are the real VCs in my view, and the later stage growth investors who come to the party with a different style, and in particular, less of an appetite for hands-on involvement in the company.
So do you think that, you mentioned in other interviews that Sequoia are probably the best at it, and is that because they're the best at being hands-on, or is that I guess I'm sort of answering the question for you, I don't mean to, but is it the best at being hands-on, or are they at best at identifying the best opportunities to begin with? Why are they so much better than everybody else? Because they're not the only ones with heaps of capital. If you look at SoftBank, they had endless capital, yet they also picked some pretty tough investments.
Their money will be the same as other people's money, I'm sure.
It's fungible.
Exactly. Everybody's money is as green as the other person's money. It's not money that differentiates. It's skill. And I would say that at the beginning of Sequoia's history, it got started in 1972. The founder, Don Valentine's, sort of differentiating genius was the ability to roll up his sleeves and work with companies, including pretty sort of oppositional founders. So right at the beginning, he backed Atari, which was one of the early, or maybe the original, video gaming company. And the founders of Atari were a crazy bunch of, marijuana smoking, alternative sort of early 70s hippies. And the founder, Nolan Bushnell, didn't believe in proper accounting or anything, and his management system was to scrawl his genius epiphanies on little pieces of paper that would then fall out of his pocket half an hour later. It was pretty chaotic, and when Don Valentine was thinking of investing, he was invited to a board meeting, and he found that it took place in a hot tub. He had to take his clothes off and get in the hot water and sort of sit around with floating beer cans in the water, and that was how the board meeting was conducted. Luckily for Don Valentine, he'd been a water polo player in the Navy, and so his authority went up, not down, when he took his shirt off. And he had the physical and intellectual presence to turn these slightly crazy, dope-smoking hippies into a real business, and that's what he did. And he did then the same thing with Cisco, as I described earlier, and I think his toughness, his ability to turn chaos into order was very important. So that was kind of like post-investment involvement. But the modern Sequoia today is a different beast, and they've thought very deeply about both sort of pipeline, meaning you can't invest in a deal unless you know it exists. So you have to have a great pipeline of people coming to see you, entrepreneurs coming to see you. And they're very deliberate about how they have made sure that their pipeline is the best. So, for example, they forged an alliance with Y Combinator, which incubates startups at the very, very early stage, so that they get first sight of the people coming out of that. Or they take their existing entrepreneurs in their portfolio who are kind of young technologists, and they say, we know that you hang out with other young technologists, so we're going to give you some money, and if you see any you think is good and you want to back their idea, do it with this money that we've given you, but then tell us who they are, so that they'll be on our radar. So they're very deliberate about broadening and making sure that their funnel is the best. And then once the funnel is there and they're evaluating lots of companies that they could choose to invest in, they are very deliberate about their thought process around which one they choose. And in particular, they've applied behavioral science insights into their Monday Partners meeting, where they make those decisions. And they've sort of imposed a system on what might otherwise be kind of just like, oh, on this particular Monday, we're feeling optimistic because the sun was shining outside as we came into work. And so we're going to back this thing. Whereas on another Monday, they might have felt more gloomy and just not done it. So they were aware that it wasn't a kind of rigorous, consistent process, and they tried to fix it deliberately by changing the way they interacted with each other. So, and then they have the post-investment involvement as well. But I think their success and their dominance is because they've gone soup to nuts. They've really optimized each stage of the venture discipline, from funnel enhancement to deal selection to post-deal sort of working with the entrepreneur.
It's interesting, that sort of capturing of the market, and when you talked about in your book the Fairchild Semiconductor and Arthur Rock, and then we're going to talk about hedge funds in a bit, but in hedge funds there's sort of Soros and Julian Robertson and the Tiger Cubs, but it seems like there's the same family tree phenomenon in VC where, and you can kind of, when you explain how Sequoia kind of puts their, this is supposed to be a compliment, tentacles through the entire VC market, it's no wonder you get the same people who sort of all eventuated from pretty much the same, beginning organism, which is Fairchild. It seems like a Silicon Valley and the US, where you mostly have done your work on this book, is a big place, but yet it's actually a really small world in terms of the people involved. Is that how you see the VC world?
Absolutely, exactly. I mean, there's a famous sort of line about the PayPal mafia, so-called. In other words, the group of people who were involved in the founding of the company PayPal around 1999-2000, who included Peter Thiel, and they merged with another payments company called X.com, which had been founded by Elon Musk. So there was Thiel, there was Musk, and then there were a whole bunch of other people, including Reid Hoffman, who went on to found LinkedIn, Rudolf Botha, who became then the top person today at Sequoia, and Max Levchin, who's founded other companies and is a major sort of technical force in the Valley. So there are all these people who came out of that PayPal mafia, who went on to be extremely powerful and influential, and that's actually the norm, not the exception. These tribes of excellence exist throughout the Valley's history. So you mentioned Fairchild, the original semiconductor company in Silicon Valley that literally brought silicon to the Valley. It used to be called
the Valley.
The Valley before it was called Silicon Valley, and it was thanks to Fairchild. And Fairchild was the progenitor of other semiconductor companies that spun out of Fairchild, including Intel and National Semiconductor. And so people talked about the Fair children, all the offspring of this original great company. And this is true up and down Silicon Valley, and it's true, as you were saying a little bit, with Julian Robertson and his Tiger hedge fund and the Tiger Cubs that have come out of that. So I think this is, by the way, further reinforcement of the idea that investment is skill. It's not just luck, as some critics would disparagingly say. And when you see these clusters of people doing extremely well, it's telling you that they learned something together. And then when they split up and went in different ways, they took that skill that they had learned and applied it. And that's why they're doing abnormally well. If Warren Buffett made this point once when he was debating an efficient market professor, Michael Jensen, in a famous debate at Columbia University in 1984, he said, look, if there were random cases of cancer dotted around America, you would say it's a random distribution and there's nothing to be learned. But if, 3/4 of the cancer was in one small town, you would want to go and investigate the water supply or the something, right? There would be something odd going on in that town that explained this concentration of cancers in one place. And it's the same with investment. If you've got outperformance clustered in one little tribe, like the PayPal mafia or the Robertson Tiger Cubs, then it's telling you that that's not random. This is actual skill.
You don't see them as a cancer, though. You see them as a provider of a social good.
I do.
Would you mind talking about how you've come to that and the key parts for that?
Well, venture capital, the case for believing that it's a positive force seems to me to be blindingly obvious. I mean, if you want economic growth, some of that can come from population growth, but a lot of it has to come from innovation. And if it turns out that startups are the best way of doing applied science, which I think is true, or at least an excellent way of doing applied science, running multiple experiments in different ways of applying science commercially through multiple startups and seeing which one works and which one gets that power law outcome. That's the best way of turning science into products that people use. And so, it seems to me obvious that the commercialization of science, the creation of products like Google Search or, the personal computer, the semiconductor, the routing equipment, all of the e-commerce that we have, all of this was created by venture-backed applied science experiments. So I think you have to be pretty firmly anti-growth, anti-prosperity to be against venture capital. And of course, there are times when growth creates problems, and Facebook may create screen addiction for teenagers or spread fake news and so on. So I'm all for regulating the bad stuff, but I think we should, definitely keep sight of the fact that in general innovation is good, and exceptions notwithstanding, we shouldn't be anti-innovation. So therefore I think it's obvious that venture capital is good. Hedge funds is a more subtle debate. Basically, my view there is that financial risk is not going away, right? So, interest rates will go up and down, currencies will fluctuate, stock markets involve uncertain bets on the future. There is risk in finance, and that's just how it is. And so the question is where do you want to house the risk? Do you want to do you want these risky financial instruments to be held by, let's say, big banks, which are going to be backed by taxpayers and bailed out if they go wrong? Or if you don't like too big to fail banks, what's the alternative? And my view is the alternative is small enough to fail hedge funds, which are not backed by taxpayers, and therefore which will make more responsible investment decisions because they know they won't get bailed out if it goes wrong. So I think that hedge funds, it's a longer debate, but they are the least bad way of assessing, pricing, and managing risk in finance, because the incentives are well aligned for the managers to do it with huge attention to detail, and the taxpayers are not on the hook if it goes wrong.
Sebastian, on that point, NZ funds, our growth portfolios are positive this year in a market that's down, and whether that's luck by design, good investing. I'm the CIO. I'll tell you what my opinion is, and it's pretty obvious. But we believe in active management. I think that's what I'm, trying to say, and therefore I wholeheartedly agree with your point that risk isn't going to go away, and if you have the infrastructure and skill set to take advantage of that, you can profit from it. But there's, over the last 10 years especially, there's been a huge outcry around the markets unbeatable, and the amount of money that's gone into passive investing has been monumental, and that's driven down fees because passive investing doesn't really cost that much. And so if you want to be an active investor, it costs more, and so therefore there's this been huge flight to passive investment, and that tells me the market or investors, whether that's mum or dad investors who are less perhaps in tune with what's going on every day because they've got their own lives which are far more interesting than the finance world. But that tells me that there's a suggestion that markets are actually perfectly efficient, But hang on, actually, there's a lot of hedge funds that are making really great returns for clients even in a down market. So how do you square that circle?
I think that markets are sort of efficient only to a first approximation. Widely covered stocks, by which I mean, big liquid companies with lots of, sell-side analysts writing reports about them and lots of people looking at them. The pricing of those stocks isn't probably not perfect because that's impossible, but it's pretty good. And so I think, passive investing for mom and pops, for, retail investments, is extremely sensible. If you can't be sure of accessing the real alpha generators who are working at hedge funds, who charge high fees, who probably have minimum investment sizes, which are way out of your own pay grade, don't kid yourself if you are a retail investor that you can beat the market. I wouldn't recommend day trading to people. And I would say, take the passive deal. You will get, very low fees. It'll be very, relatively unvolatile. And, you won't do as well as a brilliant hedge fund manager, but, you'll do as well as you can given the volume of savings that you've got. And I think for institutions to put a whole bunch of money into passive is also a good cost-saving technique. It's not wrong to do that. But it still leaves space for active managers, for institutions that have the ability to pay the high fees, write the high check to get into the fund. And because, as I said before, the efficiency in the market is only to a first degree of approximation, hedge funds that are edge funds, in other words, that specialize in those particular edges where the efficiency breaks down, then you can make positive returns from active management. And that's a good strategy for sophisticated investment funds that know how to access the good hedge fund managers. It's not for everybody. But I think, in some sense, it's like, the joke about the economist who walks down the street and sees, a banknote on the pavement and declines to pick up the money that's sort of right there on the pavement because in an efficient system it wouldn't be there. The system is pretty efficient, and normally if there's some money on the sidewalk, somebody picks it up and it won't be there. But if you see it there, then you're stupid not to pick it up. And, why are markets to a first degree of approximation efficient? It is because there are active managers out there who are thinking about what prices might be out of line, and when they see something that's out of line, they buy it or sell it and arbitrage it and move it to an efficient level. So it's not efficient kind of all by itself. It's efficient because of the active managers, because of the people who are picking up those banknotes from the sidewalk. That's why there aren't any banknotes visibly left for the most part. So I don't think there's a contradiction between saying there is a definite role for active managers, but there's also a role for people who say that's not their game and they're willing to just walk along the sidewalk as though there's never going to be any money on the ground.
As more, we've seen passive inflows over the last decade or so grow. Do you believe that impacts the efficiency of the market, or are we nowhere near? Is it increasing its inefficiency, or do you think we're so far away from that at this point it makes no difference?
I think there's a natural equilibrium. I mean, if you think about it, the more money flows into passive, if it's not just more in absolute terms, but sometimes people say, well, there's much more money in passive. It could be that as a share of total savings, it hasn't changed. But let's say, for the sake of argument, that it has changed, that passive as a share of total financial assets has gone up. I don't know if that's true, but let's say it is. it would follow from that the residual capital chasing active opportunities has gone down, and therefore that the opportunity set for each active dollar has gone up, and hedge funds ought to make more money if passive has grown. And if they make more money, then investors will see that and they will put more money into the active funds. And therefore, it's a self-equilibrating balance between large pools of passive and then these sort of shock troops of efficiency enforcing active managers.
One of the great things I loved about More Money Than God was these active managers that you talk about, the characters behind the funds, and you got that in the VC land as well. I mean, there are some really interesting people, and you know, in VC land perhaps are a bit more famous. You know, you've got the Elon Musks and the Zuckerbergs, etc. But and the Peter Thiel, and we in New Zealand we all love Peter Thiel because there's this bit of a connection because he's one of us. He's a citizen because he loves the All Blacks and perhaps also likes the fact that we're at the bottom of the world. But also in the hedge fund land as well. I mean, Soros, I think you described him as a megalomaniac, and you've got some really interesting personalities. When you reflect on both books, who stands out? Not necessarily that you necessarily like the most, but who stood out as characters that you think are just, well, what an amazing person to spend some time with and meet or talk to or research?
Well, one observation is that the type of people you find in hedge funds and then in venture capital are quite interestingly different. You know, I mean, when Lewis Bacon, one of the macro hedge fund investors I write about, did very well and made enough money to buy himself a private island, the joke was it made no difference because he was so insular psychologically already. I mean, he was this Oz-like figure hiding behind a bank of computer screens, you know, making his trades and kind of by himself. And venture capital, on the other hand, is all about going out and meeting people and connecting with people. You can't invest in an entrepreneur unless you meet them first. And you can't help the entrepreneur unless you can introduce the entrepreneur to the 5 first engineers that he's going to hire. So one is a fairly isolated business, and the other is a people super connecting kind of business. In terms of like individuals who are, you know, extraordinary, I mean, Peter Thiel is pretty extraordinary. The way he thinks is so, you know, massively contrarian. I mean, every single conversation you have, he will produce some out of left field kind of conspiracy theory / just upside down way of thinking about things.
How do you prepare for meeting someone like that? Do you just go with it and let him talk and enjoy the ride, or do you go in with a plan of what you want to get out of him? What do you do to meet Peter?
What do you ask contrarian questions knowing he's going to answer the other way? Psych him out.
I always go in with as much preparation as possible because I think if you want to get new understanding on the table, you need to understand everything that's already been understood about somebody. So you have to read everything they've written, everything that's been written about them. You have to go through the podcast they've done, the YouTube videos. You have to try and talk to people who they've worked with. And only then are you able to get the incremental insight about their thought process, about who they are, about what made them successful. And so that's why my books do take me 5 years. I mean, they're long research projects. And so, you know, with Peter Thiel, he wrote a good book, 0 to 1, with his thoughts on startups and investing. You know, he'd done a bunch of interviews that you could go look up. And I was able to know a fair amount about him before I went to see him. And then also, in his case, you know, I went back and saw him several times. sometimes in more sort of social settings, sometimes in more interview formal settings. And again, it's giving the project enough time. So when you've got 5 years, you've got time to build relationships with some of the characters you're going to be writing about, and to go hiking with them. Or in one case, I conducted an interview. I was hanging out at a conference with somebody, and he said, "Where are you going next?" I said, "San Francisco." He said, "Do you want to go there together? I'm going to tomorrow as well." I said, "Sure." He said, "Okay, well, it'll be in my plane and I'll be the pilot." So I found myself sitting in the cockpit, speaking over headphones, and that's another way of getting to know people. So it's everything from biking to hiking to aircraft, which over time builds a deeper sort of feeling for who these people are.
Why do you think they want to talk to you? Friendships aside, because in the end, when you have relationships, it turns into more than just sort of writing a book. But some of these people are pretty private.
Yeah, they are private, and they begin with a suspicion of writers and of journalists. And that's, in a way, the challenge for me. And another reason why it takes 5 years. And another reason why the result then becomes valuable, because not all writers get this access. In fact, almost none do. I'm frequently going to see people who say, "You're the first writer we've agreed to meet ever." How does that happen? Well, part of it is being introduced to these people by some intermediary who I've worked with in the past. They've trusted my methodology. They know that I'm not out to take cheap shots at people. I'm actually trying to understand the investment process. I'm not here to condemn capitalism. And so if you've got an intermediary who says, "Look, I know you don't normally talk to journalists, but this is somebody who really wants to understand, and when his book comes out, a lot of people are going to read it, so it's worth your time, and he's not going to twist what you say," you start with an advantage if you have those introductions. And then it's about a method which other journalists might dislike, but I'm perfectly comfortable with, which is that I often say to people, "Look, I'm going to draft a chapter, and you're going to be at the center of it, and I'm going to send you the chapter, and I'm not promising to change a single comma of what I've written, but I am promising to take what you say seriously. And if you think that I've got a fact wrong, I will look at it, and if you're right, I'm going to fix the fact. If you think I've got an emphasis wrong, I will hear what you say, and I will consider it. I'm not promising to take on board what you do, but I will think about it." And typically what happens when I do that is I send a draft, and then somebody gets back to me and says, "Look, this is pretty good, but really it would be better if you thought about the following." And then I get another 2 or 3 hours of interview, and we have a long conversation, and we go 2 levels deeper into the whole subject, and I get a better result because I rewrite the chapter, and it's deeper, more thoughtful, and closer to the truth. So again, this takes time. You can't do this if you're in a hurry. You have to be prepared to write the chapter, submit it, have a long discussion about it, throw it away, and redo it. So it's not for everybody, this method, but I do think it delivers the best quality to the reader.
Was it easier to find and become introduced in the Power Law, having written More Money Than God? Were people more forthcoming?
Yes, definitely. I mean, there was definitely a crossover. There were people who I'd written about, or who had not been in the hedge fund book, but kind of had read it and liked it, who were in a position to introduce me to people in Silicon Valley, and that was very helpful. I mean, the first trip I did, I remember I went to see Jerry Yang, the founder of Yahoo, on the first day of interviewing. That didn't happen just by itself, and that's because somebody who loved my hedge fund book had asked Jerry to do that meeting, and then there were a bunch of other ones like that as well.
In the book, you talk a lot about Soros and Druckermeyer's breaking the Bank of England, and the personalities obviously form a big part of that. But it was also an incredibly important moment in time. Why do you think, for the industry and I guess for more broadly across Europe and the world, what was so special about that moment and those personalities that got so much attention from you and More Money Than God?
Well, this 1992 story where Britain was forced to exit the European exchange rate mechanism as it was then, this is before the euro obviously, was, a huge political story, right? I mean, you had Britain, a G7 country, being humiliated, forced to abandon its economic policy, and with potential political consequences for the Conservative government at the time. Actually, they weathered it because the economy then bounced back. But for a while, John Major, the Prime Minister, looked as if he might be on the skids because of this disaster. So the fact that this had all been brought about by some hedge funds in New York operating out of small offices, literally with duct tape, fixing the carpet on the floor, was kind of amazing, right? The mighty Bank of England laid low by a handful of hedge fund traders. In most cases, people didn't know their names. George Soros was somewhat famous, but I'm not sure Louis Bacon at the time was a household name, probably still isn't today. And so I just think the kind of asymmetry, the sort of understanding that all of a sudden small private financial actors had enough capital at their disposal to sell sterling short and overwhelm intervention from the British government, overwhelm an attempt to defend the pound by raising interest rates, and ultimately force a change of economic policy that almost forced a change of government. It was just like an extraordinary political phenomenon. And then on top of that, Soros did make $1 billion, which, at the time, to have $1 billion fund in the hedge fund world was very unusual. To make $1 billion profit on one trade, that was almost unheard of.
That was the asymmetry of position which you've talked about before, and the worst case scenario for him was probably not making much but not losing much either, whereas the upside was quite significant, or obviously significantly doubled his fund.
Yeah, it's worth just sort of double clicking on that because it gets back in a way to our opening discussion about the power law. In venture capital, as we were saying, the trick is to not worry about the losses, but look for those things where instead of losing 1x, you might gain 10x or 15x on your investment. Hedge funds are not the same, as we were saying, but there are certain moments in hedge fund trading where you go short sterling. If you're wrong and sterling appreciates, you will lose money. But sterling was never going to appreciate in that setup by more than sort of 0.5%, because everybody knew the Bank of England wanted to cut interest rates because the economy was in recession. So the moment sterling went up even a little bit, the Bank of England was going to use that space to try to fight the recession. So Soros, in going very short sterling, had an asymmetric trade, a little bit like a venture capital asymmetry. He could only lose kind of 0.5%. But if sterling broke out of the exchange rate mechanism, it would fall maybe 15%. So there was this huge upside for Soros relative to a very small potential downside, and that's why he put so much money on the trade.
Can we talk about Stefan and Sebastian in the last 6 minutes? Because I realise you've got your day to get on with, Sebastian, but like any good CIO, I can't have someone who, I realise you write about finance, but you are deep-seated in the sector. You must have a view on what's going on at the moment in global markets and your views around, what a fascinating Jackson Hole meeting we had with central bankers pounding the table saying interest rates are going to go up. You've got the ECB, wanting to raise interest rates by 75 basis points at the same time all your energy prices, at least in the UK, are up 80% this year. How do you see things playing out in the global economy and in markets that you're close to?
I mean, you can term this as the victory of Paul Volcker over Ben Bernanke. I say this, having written a book about Alan Greenspan, and therefore having immersed myself in the history of the Fed and of central banking more generally. But I think what I'm trying to say is that the lesson from Paul Volcker was that when inflation is seriously up, when it's anything higher than 5%, a central banker simply has to prioritize price stability. And you can't sit there and say, oh, this might be transient inflation, or it's because of a weird price shock from the Ukraine war. It doesn't matter. Consumers are experiencing a real loss of purchasing power. And unless you fix that relatively fast, they're going to lose confidence in the currency. They're going to start changing their behavior in a way that anticipates more inflation, and then you'll get a wage price spiral, and the inflation will get baked in, and it'll be much more expensive and difficult to expunge it later. So the Volcker lesson is being learned. That's why Jackson Hole was as it was, banging the table saying, whether there's going to be a recession or not, it's not our primary concern. Our primary concern is fighting inflation. And this is a different sort of model. I mean, my juxtaposition with Bernanke is a little bit unfair, but he was Fed chairman in the period when low inflation was the issue. And that was true before 2007-2008 financial crisis, right? There'd been this period of Japan getting into deflation and the Fed worrying about deflation in the US, so that interest rates were down at 1% in 2004 because of the fear of inflation actually undershooting the target. And so that was true before the 08 crisis, and it was true after the 08 crisis. And in this period, Bernanke, as a sort of dominant central banker in the world, kind of pivoted the priorities of the Fed towards stimulus and towards growth and towards sort of preventing the stag part of stagflation, right? Because in fact, inflation wasn't happening. But now we're back in a world more like the 70s, and Paul Volcker's model is the one that the central bankers are following.
So interest rates up to fight inflation, and whatever happens to markets because of that is kind of a reaction that we have to accept, both financial markets but also the economy.
Yeah, I mean, we went through this long period of the Fed put, and it used to be called the Greenspan put. In other words, the idea that whenever markets were in trouble, the Fed could be relied upon to provide insurance by cutting interest rates, by providing liquidity facilities, and so forth. And, that was possible. We can date it, from roughly 1998, when the Fed responded to the collapse of the hedge fund, long-term capital management, and to the Russian financial crisis, and pumped a lot of liquidity into the system, cut interest rates 3 times after the blow-up of that hedge fund. And so that was sort of an example of the Fed put, of the Fed coming to the rescue of traders. But all of that is premised on the idea that inflation is under control. If inflation is not under control, the Fed can't afford to be doing a Fed put. And that's where we are today. We're in a new world where instead of prioritizing financial stability, the central bank has to prioritize price stability. And traders are going to have to get used to that.
It's going to be a hard pill for some people to swallow.
Yeah, although I think that actually for hedge funds, it could be a good thing. I mean, the world of plentiful money was a world in which risk spreads were compressed. And if your job as a hedge fund is to price risk, you were not being paid as much to do that intelligently in a world of massive quantitative easing by central banks. And going back to a world of higher interest rates and a riskier financial outlook, that is going to reward the active managers who can price risk. So I'm actually more bullish about hedge funds going forward than I have been in the last 10 years.
Sounds like I'll keep my job for a little while yet and not be taken over by the passive manager.
Yeah, just don't go too passive. Fantastic, Sebastian. We're conscious of time. Thank you so much for joining us. It's been really fantastic to hear about your 2 books. We hope you win the next one, and have a great day. And we hope to talk to you again sometime in the future.
Great to be with both of you. Thank you.